All right. So that was one introduction. So excited to follow up on that. Really excited. First of all, a big thank you to Token 2049 for hosting both us and this panel today, and for all of you for joining. We have a lot to pack in here, so we're going to kick it off. Let's start with just a general question. Obviously, last year was a pretty volatile year. So why don't we kick it off with just talking about how you view finding alpha in the space and just overall market changes pre and post FTX. Cheong, why don't we kick it off with you?
Sure. My name is Cheong Tang. I was the CIO of Ledger Prime, which was a multi-strategy hedge fund that I guess was part of FTX. Is a very pertinent question. Ledger Prime were relaunched by the end of the year as Eminency Group, and separately I've launched another trading firm called Algorithmic Markets, which is focused on bilateral OTC derivatives. I would say like my conversations generally in the past few months with allocators, counterparties, have focused a lot more on just operational due diligence, less on like the alpha generation. I would say something that's changed massively is just how business is done in general, right? So like if you're an allocator, historically you allocate to a fund, you follow up on a monthly basis, or multi-month basis. I think nowadays what allocators want is a lot more control and visibility. There's a lot more allocators that are asking for like sub-managed accounts. A lot more allocators, like if you're touching DeFi, looking for more just like daily like transparency and visibility. And then on the counterparty side, right, I think just the rehypothecation of collateral and margin is kind of changing. It's more about like tripod or repo and understanding like what like the margin and everything is being used for. So those are some of the changes that I've seen in the past few months.
Yeah, it's one thing that I keep coming back to. I've been trading this asset class now for 7 years, both at crypto native firms and now as a principal at GoldenTree, which is a traditional asset manager that traditionally is focused on credit, debt, distressed debt, and now has actually spun out a subsidiary called Golden Chain, which I'm a partner of, that focuses investing on the liquid markets and the venture markets in the cryptocurrency world. One thing I keep coming back to is that the markets change dramatically year after year. 2017 didn't look like 2018, didn't look like 2019, didn't look like 21, didn't look like 22, and doesn't look like 23. And the opportunities and the ways that you access the market and the things that you look for, you have to keep your nose to the ground. And you have to really understand what's driving the interest in the market. I remember back in 2019, the volumes out of Asia were much higher than the volumes out of the US. And so if you wanted to understand what was happening in the markets, you wanted to understand how to trade, you probably had to pay a lot more attention to the Hang Seng than you did to the S&P. Fast forward to 2021, that wasn't necessarily true. A lot of the volume was coming from the US. And so once you start to track these things and really understand what the driving forces are behind the markets, who's interested in the markets at any given time, you can really start to uncover alpha in a way that you haven't before. And Cheong, one thing that you brought up that's just true is it's always been a struggle in the cryptocurrency industry to house your assets effectively, to make sure that you don't take on losses. Because it's a new technology, and things break. Everything here is really an experiment. Basically, everything outside of Bitcoin is constantly in flux. And so approaching the market in a professional and rigorous fashion is extremely important to make sure that you mitigate the losses that can occur from things that are outside of your control, like what we saw with 2022 with Luna, with FTX, with 3 Arrows. You run into these situations consistently, so one thing that I always say is you always have to be paying attention. You can never really take a break here.
Good to be with you guys. All right, today the mic is working. I'm the CIO at Selene. Selene is a very large market-making firm. My background is both poker and TradFi, so crypto kind of brought those together for me. And I chose the title CIO instead of CEO because I still love chasing alpha and actually being a trader and investing. So I spend that as a big part of my time. But Selene as a firm is a very large market maker, so we provide liquidity. I know these guys that execute keep complaining about how crappy the liquidity is right now. So we can talk about why that is. Most of our competitors have left the space, but we continue to provide liquidity, and yeah, happy to get into that.
Yeah, I'm Arthur. I'm the founder of Defiance Capital. We invest in crypto. I've been investing in crypto since 2017. We've done both venture and liquid investing, but we launched our new fund this year that purely focused on the liquid crypto market because we think the risk-adjusted return in the liquid side is much more attractive right now. And I think going back to the topic of the what have changed post-FTX, I think one of the biggest thing is there's a lot more focus on holistic risk management. And I think that in a way, we probably pay attention to risk even more than the traditional manager now. In a way that in the traditional manager, you don't really think about your prime broker going down. I think that that's something that we are just so conscious on counterparty risk, custody risk, obviously market risk and everything. So you actually need to look at everything, and you need to make sure your operational infrastructure is really up to task. And actually, that's something that's quite challenging because you're working with lesser resources compared to the traditional asset manager or hedge fund, but yet you actually have a higher. You need to invest more to make sure you are up to the standard. Like you need to make sure your custody is well stood up, and if you want to do the on-chain stuff, like you can't use like a pure cold wallet custody. You need to use MPC. Then you need to reconfigure your MPC infrastructure. Then you need to prevent cyber security attack. Lazarus has been very active recently. Every month they have gotten away with like a very decent amount of money. So there's a lot, all these risks you need to manage, and I've seen it firsthand and seen so many examples of some funds that were up like few thousand %, from the last cycle and just blew up in a very short amount of time. So I think it doesn't really matter how much you are up. I think it's really about like, can you really survive and make this something sustainable? Like, are you like a one-trick pony, or actually you have a real sustainable alpha? I think that has changed, and I think there was a lot more skepticism on, is this guy just a bull market genius? Is just max leverage long the entire market, or is actually know how to manage the risk and how to extract alpha even in a difficult market condition? Yep.
Yeah, so my name is Daryl. I'm one of the co-founders of Tangent, which is a multi-strategy fund that was based in Singapore. We started at the start of this year, and I've been investing in the crypto markets for about 3 years. So I think to a lot of the points that the panelists have said, I think surviving in this industry is probably one of the hardest things to do. And relative to any other space that you're in, you have to think about so many risk vectors, attack vectors. But I think if you can continue to stay in this space and take a longer-term cycle view, the alpha is just basically being, I guess, naturally long when markets are relatively doomy and gloomy, and taking profits off the table when everyone's euphoric. So I was reading an article recently, and it was a fantastic one because it is so pertinent in today's market climate, where defensiveness is equally as important as offensiveness, right? How good you are at making money in the bull market is only as important as how good you are at defending that capital and preserving that capital in a bear market. So I think right now, with the markets the way they are, you probably want to be focusing on defensiveness, and we can get to that, I guess, later on. But yeah, I think just surviving and being, knowing how to be defensively positioned when you need to be is alpha in itself.
Sure. Before we dive into specifically execution and then also the effectiveness of getting some of the alpha structured into different strategies, why don't we dive into some of the hurdle rates between whether it's CeFi, DeFi, but also majors and altcoins. Arthur, can you dive into what are some of the risks that you see with execution or even hurdle rates that maybe has changed between some of the majors and alts? It could be, let's say, liquidity, which Jordy, you touched on, but anything else top of mind?
Yeah, I think first thing, the hurdle rate is US Treasury risk-free rate. I think that's the same for all asset class. So I think it's reflected in a manner where the allocators are just gonna think about like should I allocate so much to alternative, and crypto is part of the alternative basket. So I think that's the things that have impacted, and I think that's also one thing that lead to like a liquidity withdrawal from the market, because people don't have to take so much risk anymore to get the return they want. It was very different where interest rate was 0 and you are very happy with like a 6 to 8%. But right now when you get like risk-free of 4 to 5 or even slightly higher than 5, you probably want to be compensated more to take on such risks. But at the same time, the return expectation in crypto have changed as well. I don't think people are kind of expecting that kind of crazy return to come back so quickly. So I think that's kind of the major reason they have pulled back from the crypto space. And I think that in the out market, like so-called the non-Bitcoin ETH, that was even more obvious. Like there were just like, I would say 90 to 95% drop in liquidity compared to 2021 across most of the non-Bitcoin ETH crypto. Yep.
So liquidity, people usually think it's because of the supply liquidity. Oh, big guys are out, Citadel is out, that's why, Alameda's out. The reality is actually more related to the demand for liquidity, and we are able to always step in and provide more and more liquidity, but there has to be a balance between informed flow, kind of like insiders that are trading very profitably, and uninformed flow. And I would say, since FTX went down, a lot of the kind of more retail uninformed flow went out, and you have a lot of people that have insider knowledge of, either legal things that are going on or specific coin things. That makes it harder to market make. So very few market makers are really able to survive against that type of flow. And I think that's going to continue. Unfortunately, we're not going to get better liquidity until there's a lot more kind of retail interest that just wants execution. They just want to be able to buy. I mean, we saw with Curve, if you really want to execute 50 million of Curve, you got to do it OTC, because if you do it on chain, as a market maker, we're not going to be willing to just sit there and get filled constantly for tens of millions of, a coin that the founder can just decide to dump 50% of the supply. So it's a very tough market to navigate. I think if you're very short-term oriented, you can definitely make money. There's opportunities. I was doing a podcast yesterday with my co-host Thicky, and this alarm went off. I thought he had a fire alarm in the house, but actually whenever the FTX docket puts a new announcement, he just has this large sound go off so that he can rush to his computer, speed read every line on the new docket and make a trade. So there's people out there doing that. We got to watch out.
Cheong, how would you touch on CeFi, DeFi? There's obviously always concerns about wash trading, yield compression and yield farming, and then just in general liquidity, as Jordy mentioned.
Yeah, I think just quickly, I think what Jordy mentioned is extremely just relevant. In traditional even TradFi crypto, it's, if you're a market maker, you don't want to be bumping against other market makers. That's not the point of being a market maker as a trader. There's no edge in that. But broadly, taking a step back, we're just in a very different macro environment now as well, right? More dollars have been printed over COVID than in the history of the United States. We're at 5.5% interest rates. Maybe we're at the end of the U.S. monetary tightening cycle, but the rest of the world is not, right? They have to counterbalance the higher interest rates of the U.S. Consumers are hurting. Generally, unemployment lags the peak of interest rates by 8 quarters, so we haven't seen that yet. So with less consumer spending power and savings, just less consumer trading in the future. And I do think that's a very big point that crypto as a whole has missed, or just kind of won't necessarily completely understand, given we've been the loosest monetary cycle for the past decade, right? And then in terms of just general CeFi, DeFi, right? The hurdle rate's a lot higher, right? It's you can buy Coinbase bonds in the teens. It's difficult to justify to LPs why they should allocate, to us or other people and earn relative, similar returns from much higher risk. So that's a conversation that we're always just constantly having. And so I think as a way to kind of act that is, how do you offer similar risk-adjusted returns, whether that's through kind of better operational infrastructure, working with prime brokers, integrating technology platforms like Fractal and others to create more transparency. And we have more transparency, then the kind of risk hurdle comes down and becomes more in line with traditional assets.
Yeah, I want to touch on that point real quick, because the importance of DeFi and the reason that people were interested in DeFi has shifted a lot over the last 3 years. Let's go back to 2020 when you had DeFi summer and everything exploded and everything took off and people were chasing yields on things like kimchi farms for 1,000%. And everybody was talking about, oh, DeFi is a great way to generate yield. This is a phenomenal thing to go put your money in because there was the greatest amount of negative yielding debt that had ever existed at that time. So people viewed DeFi as this amazing asset class where you could just go put your money in and it was an infinite money machine. And what ends up happening is obviously that has to come back down to earth. Really what was invented at the time was a new way to distribute equity to early adopters of a company or a protocol. And so effectively for using a product, you were getting paid equity in the form of the token. Most of that was worthless. So most of these tokens the products associated with those tokens were not going to last for a long time. And so obviously that equalizes. It comes down. And so you fast forward to today, and you look at DeFi, and rates are much higher outside of crypto than they actually are inside of crypto. A lot of that, is just due to the macro environment, as Cheong mentioned. And so what is the value of DeFi today relative to what people perceived the value of DeFi might have been 3 years ago? Well, the value is that it's actually easier and faster and better to build financial products on a DeFi stack than it is to build it on the old traditional financial stack that was built over the last 50 years. And that's why you're seeing major banks, major PBs start to build things like tokenized money market funds. Because they see this and they say, oh, the crypto rails are actually better for trading these traditional assets than the current rails that we have. So we're going to move over slowly. And so the benefit comes less from, oh, we're going to make a lot of money and we're going to generate, it's all about yield. And then it's now more about, oh, operational efficiencies and saving costs and actually just having a better and more composable system. So I think that's been a major shift in the CeFi DeFi space.
Yeah, and just adding on to that, I think the DeFi scene right now is pretty pessimistic, right? I think the relative yields that you can get in DeFi is not comparable to what we see in treasury rates, and as a consequence of that, you've seen USDC's circulating supply continuously dwindle over months now, right? I think, and it's pretty obvious because people who typically hold USDC would also have access to treasury rates, and when you're not being compensated for that, the opportunity cost gets higher and higher as interest rates go up. But I would say that we probably are at the peak of where interest rates will hopefully be, and that consequently also means that the opportunity cost or the difference in preference for traditional markets versus DeFi is also at its highest. And as interest rates continue to come down and as more alternatives in DeFi offer sustainable yield opportunities, I do expect DeFi to come back in some favor. So yeah, I think DeFi right now as is still very much in its original, I would guess, version 0.2 or 0.3 of what it can be. But we're going to need to offer a lot more compelling and secure opportunities in the decentralized world as compared to what's available today.
Curious what you guys think if we're going to have a repeat of what we've seen many times before, where it's going to be dead. At some point, Bitcoin ETF news hopefully comes in, and then we're now in this closed system. There's not any money entering. Once it does enter, let's say through a Bitcoin ETF and potentially Bitcoin and Ethereum do well, is it going to be all over again? Speculation just goes all the way down to safe moon, or do you think this time lessons have been learned? How do you play the next cycle?
I think that if you still believe that crypto has a future and the asset class is poised to grow significantly going forward, I think you just have to find some asset you really believe in and hold on to it. If you're someone that's very bearish, I mean, set aside the active trading strategy, I'm talking about more of like an investing point of view. If you're actually feeling very bearish about industry, I think it's better to just believe and don't care about it. It's just easier that way. There's no point trying to fight in a declining market. So I think that for people who stay, you actually have to, in a certain way, believe that over like a reasonable time frame going forward, this asset class will grow in different forms. And then you just have to find something you really believe in and have to have some core position, because that's what we are in crypto for, right? And I think that sometimes get overlooked in this kind of market condition, everything is a scam. We're all going to zero, so I think that it's good to sometimes take a step back, to take a more level-headed perspective. Some things are overpriced, overvalued, and a lot of times it's really about the nuances. Like, I think this is always one of the most underrated thing in crypto, because we're all on Twitter and nuances doesn't scale on Twitter. Like everything just, a lot of things is more, I care a lot more about details right now. So I think that, even like DeFi, right? I mean, I was very early DeFi investor, ground zero. I think right now I try not to put DeFi into one single basket. I think different parts of DeFi have different kind of growth expectation. Like, I think borrowing and lending, I think that's quite tough until interest rate normalize. And also, like, we need more good asset as a collateral. Like, even for Bitcoin, we have not even been able to bring a lot of good quality Bitcoin as a collateral to DeFi. We have wrapped BTC, but I think the adoption has slowed significantly, and even that alone have not really been growing. But on the derivative side, my firm belief is a decentralized derivative will at least grow the market share by 3 to 5 times in the coming years. It's not even talking about it's going to overtake the centralized venue, but I think that the market share will increase because the core user base, which is the crypto native crowd, we haven't even really penetrated the crypto native crowd yet. So I think that's kind of the perspective. If you really believe crypto is going to grow, then you have to find something you really believe in and have a decent stake in it in various manner. Yep.
And Avi, I guess you're always looking at supply and demand. I guess unlocks now are no longer bullish unlocks that we had during the bull market. And even though Bitcoin and Ethereum have this, at this point, very steady supply where we can actually invest knowing that there's not going to be a huge amount coming in. For altcoins and other things that you're looking at, are you just chasing supply unlocks?
Yeah, that's definitely one way to trade it. I think the bullish unlock was, let's think about what leads to that, right? When there's a telegraphed supply of anything coming online, whether it's government Bitcoin that's going to be sold, whether it's investors unlocking on a coin and it's going to be sold, what you have to think about is how much of that is priced in and who's doing that pricing in. And there are 2 ways of pricing that in. The first is people are shorting that asset in anticipation of it coming online, that supply. The second way of it being priced in is people not buying until that unlock happens because they're worried about that unlock. So there's a pool of capital on the side that's waiting to see, okay, let's see how much of this sells. I'll be able to get a better price after it unlocks. And what was happening in 21 was that there was just a tremendous amount of capital that was waiting on the sidelines to buy things like Solana once we got past the fear of the unlock. And I think there were also shorts in the market at the time that got blown out. And you fast forward to today, there's still people that are shorting this, but there's nobody that is waiting on the sidelines to go buy these alts post-unlock to be able to absorb the supply that comes in. And so I think it's been a really good trade. I personally think it's not juiced yet. It's just that there's specific assets where it is juiced, right? So if you look at something like I don't want to name exact names, but you look at something that's been unlocking for a long time, that's a lot more likely to be priced in than something that comes out at a $20 billion valuation, and that the supply is going to come online. I want to circle back for a second because I think the question of whether we will see another speculative cycle and whether we'll continue to have speculative cycles is a very, very pertinent one, and it's very important when understanding crypto. So crypto is a very reflexive market. Why? Well, if you really think about Bitcoin, the bellwether asset, what gives Bitcoin value? It's the perception of value from other people. It's the acceptance of it as a currency. It's the ability that you can move it anywhere at any moment. But really it comes from what you can do with it, and what you can do with it comes from the perceived value that other people ascribe to it. What does that mean? When it goes up, it actually gets more valuable. When it goes down, it gets less valuable. And so that innate behavior of Bitcoin leads to speculative cycles. One thing, and it's funny, we're in the Marina Bay Sands. One thing that's true is humans love to speculate. I was walking through the casino, and there's a line for a Singaporean entry into the casino where you actually have to pay $100 to go in and gamble. So you're paying $100 to go in and play a negative EV game where you're going to lose. And the line is still extremely long. People are paying, right, to speculate. And people always will. And so I think because of that nature of crypto, there will always be a boom-bust cycle associated with it, because that's just human nature. It's human behavior. And at the same time, there are real things that are being built in crypto. There are real products, there are real applications, there's real value to the tech, but it's very difficult to pull out the speculative nature from this asset class, because I just think that's just what it is.
Yeah, and of course, I mean, we talked about a number of different themes, but also you have in the whole bucket of crypto speculation, you have things like stablecoins. And if you look at even just market cap, that's probably one of the only things that stayed pretty flat and increasing despite everything that's happened in the market. And the adoption of stablecoins is really important. How are you thinking about, just timely news and even just more macro and global? FTX was just approved in terms of the sale of the assets that they hold. And that's going to happen over the course of the next couple of months and years. How are you thinking about that? Obviously token unlocks is one thing, but there is now guaranteed sell pressure across some of these tokens. How do you think about that when you consider, maybe your momentum long some of those assets, or just in general market making across those different platforms for those tokens?
I mean, long term, I think Bitcoin and Ethereum, despite some government sales here and there, they're so underpriced. If you look at it as a global macro asset, comparing to gold or any other thing of that scale, these prices still seem so cheap when you zoom out. However, if the FTX estate is going to sell $50 million of something that the liquidity is very thin and the market cap, I mean, I always look at FTV and market cap. It's something that, as a fundamentally minded investor, I'm less of a meme investor. I always just want to see what is the fully diluted value that we're looking at, especially in situations that can get very manipulated in thin books. I'm not saying I would short something, because shorting is very dangerous, but I wouldn't buy something if I feel like the FTV is already very high. So macro-wise, just keep stacking up and find these opportunities where governments will, dump whatever. It's not even governments. I guess it's all these estates. There's assets that I'm very comfortable holding long term, and I think this is going to be something that in 2 years' time will look extremely cheap. On the other end, I'm very careful with things that can get a very large percentage of the supply sold.
And how do you guys think about, you have Bitcoin halving coming up in April 2024. Are there, I see you laughing. All right, you can take that one. How are you thinking about that?
I feel like this Bitcoin halving question is like a 4-year thing, I remember that there's so much discussion, especially, like Eric Moore and like Nick Carter was always debating, is it priced in or not priced in, and rainbow chart, and then, what the stock to flow. I'm not going to participate. Yeah, I think other people have more insightful thing to say on this.
Yeah, no, I would say that I think it's a hallmark event that everybody pays attention to, and even though you have a sample size of 2 or 3, it's had a 100% hit rate in terms of forecasting what bull markets have happen after. So I think as Avi said, crypto is an insanely reflexive asset class, and you I think the halving alone is probably not sufficient to obviously guarantee that a bull market comes, but it's the nuance of how we get to prices where they are when the halving happens, as well as the macroeconomic conditions that are present during that time. And I think as crypto continues to mature, the asset class will more and more trade in line with broader risk-on assets. So that halving effect is probably going to dwindle as you go on and on. But I think 2024 is going to be certainly it's setting up to be a very interesting year, especially with the partisan issues that are dictating the institutional flows coming out of the States.
I would just quickly add that, completely agree with Jordy. I think, zooming out, the asset class, Bitcoin, Ethereum, extremely underpriced. The contrarian view with the halving is like historically, a lot of the miners have been able to kind of hold back from selling Bitcoin and accumulate Bitcoin because they've managed to continuously source their expenses with just additional credit, which within the Bitcoin space was pretty loose. There was a ton of it. What is a bit different this time around is that credit has largely disappeared. And so as a result, Bitcoin miners will need to tap into the inventory of Bitcoin to continue to fund and source their income, their expenses. And with the halving coming up, it just means less revenue for them post-halving. And so that's something they're also very cognizant of going into the halving. And it becomes a game of, well, who's going to sell first, into the halving. And then lastly, just with the FTX thing, I do think a lot of like the price action you've seen recently is kind of like front-running the kind of estate sale. It's the very narrative thing. But like the estate just literally got approval officially today. It's going to take a couple of weeks for anything to start. A lot of the Solana is locked up. There's a cap on like the weekly, et cetera, amount of assets that can be sold. And I do think it's more of a slow sell process as opposed to like a bum rush for the exits. They're not going to just be like hitting like liquidity on the CeFi exchanges against like market makers. A lot of it will be OTC, which will minimize like price impact as well. So I think like, again, longer term, it's probably like a bit exaggerated in terms of like just how much like pressure that is.
I want to talk. Oh, sorry, Jordy, go ahead.
I mean, I don't think the Bitcoin halving is yet a meme. I think it will be in 8 years once we have a couple more, because you go 4% to 2%, 2% to 1%. That still kind of matters. It's still, instead of 10 billion sell pressure, it's 5 billion. Right now in this environment, that's a lot. 1% to 0.5%, maybe like, in 4 years, it'll still matter a little bit. So I'm still bullish on the halving. I do think, in 32 it just becomes like a meme, like a rainbow chart. But we have a little bit of juice left.
A little bit of juice. But I also think that it depends a lot on what's happening around it, right? Because the halving is this moment where everybody just looks at Bitcoin. But if there are other things that are happening that are good for Bitcoin at that time, then it makes it a much more powerful event. That's kind of what happened in 2020. You got the helicopter money, you got the balance sheet expansion, you got everything happening at the same time that was so good for Bitcoin, and then the halving happens, and everybody's like, oh my God, this is really good.
But what we saw last year is like, there's anything that can happen. There's like truckers in Canada. Oh, good for Bitcoin.
Exactly.
There's a war in Ukraine. We can sell, like, there's so many things that will align. And next year when it happens, and I'm pretty bullish on the halving, you're going to call me and say like, hey, Jordy, you got lucky. It's because, Donald Trump is like doing this or whatever. I'm like, there was always going to be something that was going to catalyze.
I actually think that there's a non-trivial percentage that we get just rate cuts into the halving, and that itself will just be used as narrative fodder to actually send Bitcoin up. So I'm going to call you and say, hey, we both got lucky.
All right, I want to wrap this up on one last question. Obviously, you can't go around and talk about exactly how you get your alpha across your different strategies, but what is something you're super excited about? I know 2024, we're setting it up to be a very volatile year. You guys have this bet going on. We want to see who wins. But what else are you really excited about, whether it's alpha or even just specific themes outside of what we talked about? We can go around. Actually, Daryl, why don't we start with you?
Yeah, no, I think if you look at how the NFT market has progressed over the last 12 months, you really see a lot of capitulation out of even the most die-hard holders. I think a perfect example is Bases, which was the golden project of the last cycle, really coming back down to earth. And I do think NFTs as an asset class, what you saw in 2021 was the first step of an iteration of how you trade, I guess, more illiquid assets. And I think there are a lot of smart builders in this space working to develop the infrastructure needed to facilitate more of that kind of trading. So NFTs in general, the concept is quite comfortable for most people. I mean, most people trade watches. Some of them resell their cars. This is something that is pretty ingrained in human culture. And if you look at where NFT prices are today, or any of the NFT protocols that do have a liquid token, they're trading at pretty depressed prices right now, and probably for good reason if you plot them out on a fundamental perspective. But when the speculative fervor comes back, and I do agree with Jordy and Avi there that we do expect some to come back next year, I think this asset class is one to watch, definitely.
I think I'm most looking forward to all the overhang and uncertainty from a few major issue and big elephant in the room getting removed. I was talking to a lot of the crypto investors over the past few days, and one thing that strikes me is most of us sign up to invest in crypto because we are excited by the technology, the vision, and the product. But I think right now, most of the liquid crypto investor we need to be a macro expert, we need to be legal expert, regulatory expert. We spend so much of our time looking at all this, not really what we sign up for in crypto. And I think that's kind of getting a bit old. I'm looking forward to being able to focus more on the pure crypto fundamentals type, instead of looking at spot Bitcoin ETH approval and regulatory action, enforcement, all this thing. I hope that the overhang can be resolved. Even if we're going to get a big correction, let's just get it away as soon as possible so we can spend less time on this. Yep.
Yeah, I think we talk about the big correction coming. I've heard that a lot. Actually, during this conference, everyone's ready for the big correction as opposed to the slow drip that we're currently seeing right now. So with that, Jordy, what are you most excited about on the alpha side and into 2024?
So I'm excited about two things, and they're a bit more fundamentally based. One, the actual product of crypto, the user experience of using a blockchain product was pretty bad last cycle. Grandmas are not going to go on and get on MetaMask and add account. It's just awful, and people are getting hacked. I go to all these hackathons around the world, and I see a lot of smart people working on account abstraction, security, getting away with seed phrases. Maybe that's controversial, maybe not, but I'm excited about the actual product and the usability so that next cycle, people can actually have part of their financial lives on-chain, maybe with traditional yields being stacked on top of DeFi yields. So stablecoins having yields and being very safe, and then we can actually use them. And then the other thing I'm excited about is just one word, BlackRock.
I 100% agree. I think that the most bullish thing that's happening right now in crypto are the development of applications that people actually enjoy using. And so if you look back in 2021, the best trade that you could have possibly taken were all the L1 trades. And the reason is because they were viewed as an index bet on the crypto ecosystem. Oh, you buy Avalanche because if any apps do well on Avalanche, then Avalanche, the token itself, does well. Same thing with Solana, same thing with Matic, right? But the reality is that you need actual apps with actual usage to make that trade viable. And I think people are starting to realize that. And so I've been spending a lot of time just looking at consumer apps, institutional apps, just things that people enjoy using on crypto, and I'm starting to see that bubble up. Actually, NFT infrastructure, the trading infrastructure around it is getting a lot better. There's some good bets to make there. So just in general, I think that the next 2 years are going to be a lot more focused on apps than layer 1s or 2s.
Yeah, I'll just quickly add that it's completely agree. Just moving past just token prices, but actually looking at the progress of the whole industry, which is not just speculation, right? I think there's a ton of real world use cases that are being built. It's not just pure DeFi pumping and dumping tokens. Infrastructure is getting better, connecting real world assets. So I think that's really exciting. And now, as investors, that's a different kind of role that we'll have to take in terms of understanding how we can actually monetize that for investors. But that's something I'm pretty excited about. And then, last thing is on the speculative side, I think Friend.Tech is pretty interesting. I've already, purchased all these guys' Twitter accounts because I don't really go on Twitter much. So if you can pump their, bags, that'd be great.
Thank you.
Well, thank you guys so much. And a big thank you to all of you for listening in, and Token 2049 for having us.